Hi everyone, my name is Aled Phillips, Chartered Financial Planner and Operations Director at Niche. I'm glad to say we're back at our offices, albeit with social distancing measures in place. And it's nice to have everybody back, or a large percentage of our staff, and to see a busy working environment again. Of late, you'd have seen many news articles regarding market volatility, some exaggerated and some in line with actually what the market had moved that day. A key example last week was where there was a fall of 0.4%, which is a very small, daily fall that you see in a normal trading day, and the headline was that the FTSE had slumped based on several news factors. So it's always important to remember that volatility is a part of investing. However, there are more reasons now than ever that the market is significantly moving around. One of these is the uncertainty that the presidential election brings. Obviously, Joe Biden is slightly ahead on the polls at the moment, but as we know, Trump can bounce back. The trade rhetoric with China is very likely to continue, and that again brings significant volatility in the US and therefore the UK markets. Another factor is unemployment and the effect that the end of the furlough scheme has in the UK. So obviously there's the decrease in the amount that the companies will receive for the furlough payment, but then there's the uncertainty over how many people will actually have jobs to go back to at the end of the furlough, at the end. So again, that brings uncertainty and market volatility. The UK is very reliant on the service sector, far more reliant than some of its European counterparties, and therefore, if the rebound in the service sector is not as expected, again, that will cause a drag on performance in the UK. There's also a clear lack of visibility in markets in terms of companies' earnings, with many sectors obviously not back to being fully functional, and therefore earnings reporting in the next few quarters will continue to cause volatility in investment markets. There's also the end of mortgage payment holidays and the impact that has on the UK housing market. So when people come off those payment holidays, which around 17% of borrowers in the UK have taken up that option, which obviously will have a knock-on effect on the housing market once people finish those payment holidays. All of these factors we'd expect to continue to affect the market as we move along the next few months. So expect to see values continually move around, and remember that it's all a part of investing. So the ups and downs are a part of investing, and it's always important to remember that you invest for the longer term. Certainly if you're in a pension fund, and if the funds aren't needed for a number of years. But if you remember, as Ray mentioned on previous videos, we always account for all of this. We make sure that it's accounted for in our clients' financial plans, and that we've stress tested plans for far higher drops than what we've seen during this virus outbreak. So I'd like to finish by wishing you all well. I hope you all keep safe, and as ever, if there's any questions that any of you have, please don't hesitate to contact us at the offices. Contact your advisor or our para-planning teams. We're operating completely as normal, so please feel free to contact us at any point. Thank you.